Welcome back, my money-savvy friends. Today we're diving into the age-old tax conundrum, tax credit or tax deduction. Which one should you cheer for and why? It's like asking whether Batman or Superman is better. It depends on the situation, but one definitely packs more punch. By the end of this video, you'll not only know the difference, but also have some killer strategies to maximize both. So grab your coffee, your calculator, and maybe a notebook, because we're going to make taxes, dare I say, fun or at least tolerable. Let's go. All right, let's start with the tax deduction. Think of a tax deduction as your coupon for your taxable income. If you made $70,000 last year and you qualify for a $10,000 deduction, Uncle Sam says, congrats, you only owe taxes on $60,000. Basically, deductions reduce your taxable income. They're the introverted accountant of the tax world, quiet, efficient, but incredibly important. Examples: mortgage interest, student loan interest, and those charitable donations you made because you're just that generous. Go you! Now, tax credits are the rock stars of tax season. If deductions reduce your taxable income, credits directly reduce the amount of tax you owe. Let's say you owe $5,000 in taxes, but you have a $2,000 tax credit. Boom! Now you only owe $3,000. It's like a tax fairy waved their wand and said, you owe less now, you're welcome. Some of the most popular tax credits include the child tax credit, the earned income tax credit, and the American Opportunity Credit. And yes, they sound fancy because they are. These bad boys save you cold, hard cash. Let's put them side by side for a smackdown. Deductions lower the amount of income that gets taxed. Credits, on the other hand, directly lower your tax bill. So, which is better? Well, credits are usually more valuable because they reduce your tax bill dollar for dollar. Deductions, while still helpful, depend on your tax bracket. For example, if you're in the 22% tax bracket, a $1,000 deduction saves you $220. But a $1,000 credit, that saves you the full grand. See the difference? It's like comparing a slice of pizza to the whole pie. Both are good, but one's way more satisfying. Not all tax credits are created equal, my friends. Enter refundable and non-refundable credits. A refundable credit means you can get money back even if you don't owe taxes. For example, if your tax bill is $0 but you have a $1,000 refundable credit, the IRS says, here's a check for $1,000. Sweet, right? Non-refundable credits, on the other hand, only reduce your tax bill to $0. No refunds, no extras, no party favors. They're like that friend who always pays exactly their share of the bill. Useful, but no bonuses. Now that you're a pro on credits and deductions, let's talk strategy. Here are some tips to maximize your tax savings. 1. Itemize when it's worth it. The standard deduction is great, but if your itemized deductions like mortgage interest and medical expenses are higher, go that route. 2. Stack the credits. You might qualify for multiple credits, so claim as many as you're eligible for. Double check with a pro or tax software. 3. Don't forget carryovers. Some deductions and credits can be carried over to future years. Don't leave money on the table. And whatever you do, don't try to game the system. The IRS has zero sense of humor. Trust me, I've tried. All right, folks, there you have it. Tax credits and deductions demystified. Remember, deductions are your trusty sidekick, but credits are the MVPs of the tax game. Now it's your turn. Are you team credit or team deduction? Let me know in the comments. If you found this helpful, or at least mildly entertaining, give this video a thumbs up and subscribe for more tax tips, money hacks, and dad jokes. And hey, share this video with that one friend who always waits until April 14th to start their taxes. You know who they are. Thanks for hanging out, and I'll see you next time for more financial wisdom, sprinkled with a little humor. Until then, may your deductions be high and your credits refundable.